bring in Bob Iaccino, founder and president of TraderOutlook.com, who joins us from the CME Group. Bob actively trades currencies, metals, and stocks. Also joining us is Hank Smith, chief investment officer of Haverford Trust, which has $6.5 billion in assets, primarily large-cap dividend-paying stocks, probably just the stocks that you want to have, I would guess. Hank, let me start with you and ask you what you think about. We had a pretty sweet September, right?
Right.
How's October been, and what's the outlook?
October's been very well, but I was asked the other day, has the market gotten ahead of itself? And the answer is no, because the fundamentals are also on the rise. Earnings are on the rise. So is the market due for a pullback? Maybe we're buying a little bit ahead, buying the rumor, a little bit ahead of the news being the elections and the FOMC meeting. We could get a little pullback then, but it's going to be shallow and short-lived. This market's heading higher.
By the way, the market has done well. Earnings have done well. Sales are even growing. Why do you see this when all the economists are talking about a new normal, or they're very bearish, or it's a third depression? How do you explain then the fact that sales continue to rise? 85% of the companies come out and beat estimates.
Well, there's got to be a lot of pent-up demand, because for 6 to 10 months, consumers were frozen. Look at auto sales. We've been now for 4 years with unit production 25% below replacement rate. How long can that keep going? So there is pent-up demand, and don't bet against the U.S. consumer.
Hey, Hank, I got to jump in here because I'm listening to you, and I think Matt challenged you somewhat already on this, but you say the fundamentals are improving. I'm here at this summit, and we're looking at what's going on in America, whether it's the deficit, the educational problems, less R&D being spent by America, wage growth we're not seeing, wealth we're not seeing among Americans. I mean, how can you say that fundamentals are improving?
Well, look at the earnings so far, with 20% of S&P 500 companies reporting earnings are up 37%. As Matt pointed out, sales are up. So corporate America has responded incredibly well and aggressively with the recession, the financial crisis, and, quote, this new normal in terms of cutting costs, increasing productivity, adapting to the environment. And ultimately, stock price performance is about earnings growth. So we feel very confident.
Bob, let me ask you about the strength we've seen in the equities market. I mean, how much of that can you attribute to the weakness that we've seen in the dollar so far, and the weakness expected in the dollar as the Fed is expected to implement quantitative easing again?
Well, I think it's the majority of it. A lot of factors went into what we're seeing in October, a slightly over 3% gain for the S&P, which is really almost half of the gain for the year. So if that doesn't illustrate the volatility, I don't know what does. We can lose half of the year's gains if we just retrace October. But having said that, I really do think that it's the weakness in the dollar, the exports coming in. Companies were expected to beat earnings, and they didn't disappoint. It was lowered guidance that they're beating earnings at, but that doesn't make me negative on the equity markets at all. I think we're definitely going to have a pullback that's going to pull back somewhere in the range of 11.25 in S&P, and then people, at least those people with a duration to look toward December, the end of the year, and that's it, should be looking to buy it from there, because I think stocks will go higher. I don't know if you like having two guests that agree, but I completely agree with Mr. Smith that it's going in that direction. I may have a shorter duration than him. I know I manage less money, so I may have a much shorter duration, but I definitely think in toward the end of the year, I've been saying it on your show, we're going to have a rally to continue. Again, I'm setting up to take some dollar long positions pretty soon. Very soon against the sterling, a little bit more time, but also against the euro.
Hey, Bob, it's Dominic here. One of those kind of, optimistic signs, Margaret Brennan and I were talking about this earlier on the day, this idea that chart watchers are seeing something called a golden cross, that is short-term averages going above long-term averages. A fancy way of saying that there's momentum behind this, right? I mean, is that the case? Are we going to see that add to kind of like this buying, this optimism out there?
Well, golden cross isn't the term that I use, but I'm seeing exactly that same setup in sterling versus U.S. dollar, telling me to go long the dollar. The same setup is starting to take place. Hasn't done it yet, but starting to take place in U.S. dollar versus the euro. So I'm getting ready to go long there as well. And all of that combined with a short-term dip in the stock market, I'll be out of those currency positions before I take more longs in the equities. But again, every trade is about duration. And I think when the people that Carol's talking to at the summit are looking at, when they talk about the damages in education in the U.S., that's 20 years out. I'm talking about 20 weeks out.
Hey, Bob, I got to jump in here because you made a comment about wanting to actually go long the dollar. You also want to be long stocks, but over the past month and a half, they've been going in opposite directions. So are you saying that that's going to reverse and you can actually be long both the dollar and the stocks?
No, I actually love that comment because what I'm seeing is that the dollar, sterling versus U.S. dollar is either going to 160, 185 or 144. Okay, when I get the trigger to take that short, which I think 144 is more likely, I'm going to take that trade and get out of my equity positions. Having said that, when I get into that sterling position where long dollar, short the pound, when that position is over, that's when I'll be loading back up into my equities. The patterns, they're inversely correlated right now. And that's why I said earlier, I'm looking for a stock pullback. That's when I'm going to be taking my dollar longs. But I will look at the trades as individual events.
Oh. And Hank, I want to bring you back in this conversation because in a couple of weeks we've got the midterm elections here. Right. How is that playing into your thinking in terms of the environment, the outlook here for stocks?
Sure. Well, I think at a minimum there are going to be enough seats gained by the Republican Party that we're going to ensure gridlock. Gridlock is good in this case because it means no more major legislative efforts for the next 2 years, and small business can finally start planning, and you need to plan before you can hire. So that's a good step.
I want to just quickly ask you one more question, Hank, only a few more seconds, but what do you think about, you have a longer window, what do you think about the possibility of quantitative easing that we were talking about with Bob Iaccino? Is that a bad news in the long run?
Well, I'm not sure. I'm not going to sell the Fed down the river. I think, obviously, they have their challenges going forward. They're walking a fine line. They don't want to repeat the policy mistakes of the 30s, but at some point they are going to have to retract some of this liquidity, but that's further out. We tend to forget with this near-term focus, what are the consequences, what are the alternatives? Everyone complained about TARP. Well, what if we didn't do TARP? We wouldn't have a financial system here today.
And as we've learned this week, it's actually making money, and so is the PPIP.
Exactly.
With a little help from the Fed. All right, thanks so much. Thanks so much for joining us. Hank Smith of Haverford and Bob Iaccino, TraderOutlook.com.